What are the key pension regulations I need to know? Imagine planning your retirement and wanting to make sure your pension is safe and reliable. Knowing the rules that govern pension plans can make a big difference in your financial security. Let's walk through the main regulations you should be aware of. First, every pension plan must have a formal plan document. This document explains how the plan works, who can join, how much you and your employer can contribute, and how benefits are paid out. It must follow federal laws like the Employee Retirement Income Security Act, which sets standards to protect your benefits. The plan document needs to be kept up to date with any legal or operational changes. Next, eligibility rules specify who can join the plan. Usually, employees can participate if they are at least 21 years old and have completed a certain period of service, often 1 year. The plan also states when employees become eligible to start contributing or earning benefits, typically within 6 months of meeting these requirements. Contribution limits are another key regulation. There are maximum amounts that can be contributed each year by both employees and employers. These limits prevent plans from giving unfair tax advantages. For example, the total annual contribution limit for pension plans is set by the government and adjusts yearly. Plans must also perform non-discrimination testing. This process ensures that benefits and contributions do not favor highly paid employees over others. It keeps the plan fair for everyone. Vesting rules determine when you gain full ownership of your pension benefits. Usually, you become fully vested after a certain number of years of service, which can range from 3 to 7 years. This means if you leave the company before that, you might only get a portion of your benefits. When it comes to taking money out, there are rules about distributions. Most plans requiring you to start withdrawing benefits at age 72. You might need to get consent for some withdrawals, and plans often offer options like joint and survivor annuities to protect your spouse or beneficiaries. Plans are also required to provide clear information about your benefits. They send out documents like the summary plan description, explaining your rights and how the plan works. Any major changes are communicated through updates called Summary of Material Modifications. Transparency helps you understand your benefits and plan for retirement. There are strict rules about benefits being protected from creditors or legal claims. Benefits cannot be seized or transferred except in specific cases like divorce. Plans must operate solely for the benefit of participants and their families. Funding is another important aspect. Employers need to contribute enough money regularly to ensure they can pay out promised benefits. They often use actuarial valuations to check the plan's health and adjust contributions if needed. Good governance is also required. Plans must have policies in place to manage risks and investments wisely. Boards overseeing pension funds are responsible for making sure the plan stays financially healthy and complies with legal standards. Understanding these regulations helps you see how your pension is managed and protected. It can guide your decisions about when to retire and how your pension fits with other savings. Knowing the rules about eligibility, contributions, vesting, and distributions makes planning your retirement smoother. In short, pension regulations cover everything from how plans are set up, who can join, how much can be contributed, when benefits are vested, and how they are paid out. Staying informed about these rules helps you make the most of your pension and reach your retirement goals with confidence.